Hi guys, how you doing? I made a video about my short and long term view on the market back in January, and I figured since it's been about 5 months, it's probably a good time to reanalyze the markets, the data, the situations that we are in and entering, and kind of come up with a plan for when to kind of re-enter and start buying into the market because we're starting to see some really good deals on assets that we probably would have died for about 6 months ago. All right, so before we dive into it, I just want to go through my rule of thumb for the markets. So, markets become more efficient over time. They get better at digesting information and shifting money around throughout the system. Another thing is financial markets are usually a leading indicator to the economy. Since they can digest information quicker, react to it quicker. Usually, it's a good leading indicator of what's about to happen within the economy, such as recession risks, inflation rises, things of that sorts, unemployment. And another reason you can see that is last year, risky assets such as like the Zooms and things of that sorts, those stocks, those shares started tanking months before the blue chips, the S&Ps, the Nasdaqs, things like that, because money was kind of shifting around away from riskier assets. And then once there's not as many risky assets left, um, or there's just nowhere to put your money that isn't risky anymore, then you start to have pullbacks within the market as a whole. So that was a good sign of that. Also, uncertainty leads to overreactions. Fed intervention takes about 6 to 12 months to present itself in the real economy, but very quick in the financial markets. So even though last year or 2 years ago we were going through the COVID pandemic, the markets were rallying pretty heavily off of the signs of the market or that the Fed's starting to print money into the system. And then also just keep in mind kind of the asset classes and how they work. And I'll show you that in the next slide, which is just this kind of metaphor right here. So basically, you can think of the wave being the liquidity, the dollars in the system, the money in the system, and it extends and retracts. And as it extends farther and farther up the beach, the riskier the assets get ballooned. The riskier assets get ballooned. So you goes from dollars to bonds to dividend stocks to blue chips to growth stocks to IPOs. And that's why you could see, like in a time like last year, IPOs were at all time highs, is because there was just so much money flushed in the system that things were getting overinflated. Valuations were, at all time highs. And once that happens, that's when you can start seeing sort of the pullback, the wave starting to take place and position yourself accordingly. And it's the same thing in reverse. So, on that note, let's dive into the current environment. So right now we have inflation at 8.3%. The Federal Reserve has started quantitative tightening this month, which is May, and they're actually doing it 2 times faster than they did in 2018, which is the only other time that they've done it. And quantitative tightening basically means taking money out of the system. So basically, throughout the past 2 years, they've been buying up mortgage-backed securities and bonds or treasuries and putting money into the system. And now that they are worried about inflation, they are selling those mortgage backed securities and those bonds back to the market and taking money out of the system. So money is becoming more scarce. Also, they are raising interest rates. There's a large increase in consumer debt, which is not a good sign. Usually that means that people are over leveraged or they're starting to put their bills and monthly expenses on debt, which is usually variable. And then the last thing is supply chain shocks are still going on throughout the world, and they have been for the past 2 years. Nothing new. And all these factors don't really show any signs of reversing the near term, potentially besides inflation, but it has a long way to go. All right, so I want to go through quantitative tightening and show basically what happened in the last session, and also keep in mind that the markets do get more and more efficient. So because of that, I do expect it to be a little bit different, but it's still worth pointing out. So basically, we started quantitative tightening around the beginning January of 2018, and then ended it July and August of 2019. So a year and a half long. You can see I also put the balance sheet of the Fed on the chart, and they sold off about 700 to 800 billion dollars worth of assets. And that time, the market basically moved sideways the entire time. You could have sold at the top and bought back in right at the same point. But in between there was a lot of nice buying opportunities that presented themselves. And we could have used those to get in the markets and make a pretty hefty return. Now, basically, this time the Fed announced it in about October, November, and December that they were going to start quantitative tightening. And in doing so, the markets have definitely anticipated and reacted to that accordingly. So a lot quicker than they did about 3 years ago, 4 years ago. And we can see we've sold off about um, 15 to 20% in the overall, S&P market, and we haven't even started selling assets off the balance sheet yet, or just started enough, but it's not making a dent. And we're doing about 2 times faster than we did in 2018. So in doing so, we have to kind of anticipate there definitely is going to be more of a drawdown in the markets, at least initially. All right. So now that we know the current environment, how do we know when it's shifting, when it's a good time to start, putting our money to work? And there's 4 things I'm looking for personally: a slowdown of inflation, the bailout of a collapsed sector, reversals of quantitative tightening, and starting to have some of the worst weeks in the market. Now, inflation, because that is the Fed's main priority. A bailout of the sector, because basically the Secretary and Powell have already vowed to bail out if that's the case. Quantitative tightening, because it puts selling pressure on the economy. And having the worst days in the markets could just be overreactions. So those are the 4 things I'm looking for before I start deploying capital. And I'm going to dive into those a little bit more. So this is the CPI data, which is just inflation. And between March and April of this year, we've actually potentially hit an inflection point. So we went from 8.5% year over year to 8.3% year over year. So we've had a little bit of a decline, and you can kind of see with how the CPI data reacts. It's very linear. That's how kind of prices work in the economy. So because of that, we could potentially start getting a reversal, and hopefully with the Fed getting this information, they could start slowing down their new policies with being so aggressive with their selling off and their tightening of interest rates. All right, so on that note, what is the risk? What are the sectors that are in risk of collapse? And the 4 main ones I'm looking at are consumer debt, insolvent investment firms, corporate debt, and federal debt servicing. All right, so this website is the Federal Reserve Banking of New York, and basically it's just going over consumer debt, consumer and household debt. So this first chart is showing debt kind of at an all-time high, housing and non-housing debt. Breaking down into non-housing debt, we have a very sharp rise in student loans and auto loans, which is nothing surprising there. So that's kind of a rocky sign of just basically people are kind of over leveraging themselves, and could be worth taking a look at. Now, delinquencies are at or near lows, which is great for all these different financial instruments. So in doing so, there's no risk right away of a collapse there, but it's definitely worth keeping an eye on, and I'll leave this website in the description below. It updates every quarter to take a look at. For consumer debt is its growth overall. So basically this shows total change of billions of dollars of seasonally adjusted debt, and you could see as soon as 2021 ended, we started having a sharp incline in its debt. So basically 7% at Q4 of last year, and basically 9.7% in Q1. So debt is definitely increasing, and if we start having debt increases while the economy slows down as a whole, that's never a good sign for people being able to pay off their debt and afford the lifestyle they're living. Now, investment firms basically being over leveraged and starting to collapse. An example of that is Tiger Global. They're definitely more of a aggressive investment firm, but they've took about a $17 billion loss this year. And to put that in perspective, basically the fund has now wiped out about 2/3 of their cumulative investment gains since it was founded in 2001. So, just a sign of investment funds, hedge funds, starting to have sort of this tension of bad stock market decisions and investments into riskier assets that they shouldn't have made. All right, next one, corporate debt. Basically, to kind of show these gray areas are recessions, and you can kind of see the 1990s. Basically, corporate debt divided by their gross domestic product. Their GDP was about 43% here, 44% at the GFC, or at the .com, and then in the GFC was about 45% at its peak. And going into COVID, we were at about 57% debt to GDP for private companies. And right now we're about 49% right now. So just worth keeping in mind, companies are still very over leveraged, and they're even more than they ever have been in the past. So worth keeping in mind about that. Last one is the federal government debt servicing has been growing drastically every year from just their, ridiculous spending. And you can see it's very hard to kind of, quantify it because it does have a lot of up and down fluctuation. But you can see from 2000, it was about $361 billion a year. $361 billion a year, just to fucking reiterate. And then just last year, it was about $562 billion a year. So I believe that represents about like a 22% take of their actual income. So of all their taxable income, about 22% just goes to interest rate payments on all their bonds and treasuries. And I think is worth pointing out. All right, so with all this being said, let's say one of those four situations play out. How do you know if you're getting a good deal on your assets? And I think the best way to do that is to confirm against inflation. And since inflation data is so skewed all over the place, I think the best way to do it is just go to the root of money, which is the money supply. How much money is in the system as a whole? And that is actually spelled out pretty well with M2. So M2SL, if you type that on TradingView, is what you'll get for the money supply. And you can actually divide any asset that you're interested in, divided by that. I believe it can only be done in the day, the day setting. But you can basically use that and see if your asset is actually at a discount, a premium, whatever the case is. I'm going to show you through two assets right now. All right, so we're going to start off. This is the S&P divided by the money supply, M2. And you can see right here, basically, the money supply has been bouncing back and forth ever since the 60s. Definitely took a big deviation to the downside and then big deviation to the upside. It's kind of been chilling in this channel ever since the start of the century. So we had the .com crash right here. We were way overinflated. Basically, 33% of the money supply was in the stock market is a good way to look at it. At the Great Financial Crisis, about 20% of the money supply was in the market. And then at its lows, we only had about 8% of its money in the markets. COVID, we had 22%, back to its lows. And then just this year, we've actually had it at about 23% of the total money supply being in the S&P. So it's worth keeping in mind. The valuation is 23%. I should put it as. But basically, this is a drastic change, a drastic way to look at it compared to if you just look at a market without dividing it by the actual money supply. You never know when to actually buy. It all just looks confusing. I mean, you're just thinking it's going to crash to zero, and obviously that's not the case because the amount of money in the system has changed. So I think the best way to do it is through the system, which is dividing the money supply. So there's the S&P, and now onto Bitcoin. So Bitcoin, if you're in crypto, basically I wanted to mark out this level from the 2017 highs to the 2020, 2021, and so forth. You can kind of see it's all within reason. They have very similar values from the highs to the lows. And even the two highs made last year in 2021 between April and November were actually spot on. They're the same valuation. Even though we had a higher high on the actual chart, we didn't make it when you divide it by the money supply. And I think that's just a very interesting thing to keep in mind. Going through to see if you're getting a good deal on your purchasing power or not. And you can see right now it's in a discounted area where it hasn't been for a while. There is probably a little bit more room to breathe, but in that case it still is discounted. and not a bad place to buy. All right, two more things I want to just point out for you to keep in mind. I think are probably worth saying, and that's this situation the Federal Reserve is in is completely different than any other market pullback due to their only two options that they have being already exercised. So the Fed can really only do two things. It can print money and distribute it, or it can lower interest rates, so lower the funding rate. It has already exercised those two, and we are in this predicament because of those two. So interest rates are near low, which caused lots of borrowing and inflation, as well as they printed a lot of money, which caused inflation. Now, interest rates right now, I believe, are still below 1%. So with that being the case, they're going to go from 1% to 0% if there is a collapse of some sort. Really isn't enough compared to like back in the Great Financial Crisis. They were able to drop it from 5% to 0%. So that's a lot more wiggle room. And they also can't print a ton of money because they're dealing with inflation right now. So it would just add to more inflation, which would be hyperinflation. So with that being the case, I really only think if they bail out, a sector that fails and start printing money again, I think we're going to enter in a hyperinflationary state, and I think all the money you have should be entering assets, just because it's going to make no point to hold on to money that's just going to be degrading in value, in double-digit terms year over year. Another thing I want to point out is there is a ton of jobs available right now. I mean, we have labor shortages, so with companies still cutting back on their hiring, I think we're not going to have a huge issue of unemployment rises just because we have so much available work out there that that I wouldn't be too worried about that. All right, to recap, two things I want to point out. Basically, the two steps I'm waiting on are I want one of those four scenarios to take place to start buying assets heavily. And I'll still trickle some money in when I'm seeing a good deal for the time being. But I'm not going to throw everything into the market just yet. And once I do find, one of those four scenarios working out, comparing it to M2, the money supply, and making sure I'm getting a good value for it. Because with the money, being thrown around all over the place in the system, it's very hard to actually keep track and see if you're getting a good deal on your purchasing power or not. And I think that this is the best way to figure out the least amount of manipulation towards your assets. So, that being said, thank you for watching, and good luck. Let me know if you have any questions, and have a good rest of your day.